Hello, I'm Haider Malik, and this is the Mehmi Financial Group podcast. Today's topic is Vancouver Parts and Service Financing, minimizing downtime for BC fleets. Let's jump right in. When your service bays are packed and parts inventory is swelling, yet customer invoices hang out 30 to 60 days, you need reliable financing to keep trucks rolling. I'm going to walk you through the financing tools, lender options, and best practices that Vancouver fleets use to fund parts, labor, and emergency repairs without missing a beat. First, let's define why a dedicated parts and service facility matters. Unlike your floor plan line for inventory or your term loans for new rigs, this revolver is built exclusively for operating expenses, parts stocking, technician payroll, sublet work. It bridges the gap between when you issue that service ticket and when the client's payment clears. There are three core structures. 1. Receivables, secured revolver. You pledge signed service invoices, bulk filter changes, brake rebuilds, hydraulic hose work, and borrow up to 80% of their face value. Draw to cover parts orders or payroll, and repay as customers settle. You pay interest only on the drawn balance, matching your cost to revenue. 2. Inventory secured line. You use high-value parts, engines, transmissions, steering racks as collateral. Lenders typically advance 52 to 65% of wholesale value. That's ideal for pre-buying seasonal spares like winter-grade tires or cold climate filters, so you never run out when the freeze hits. 3. Short-term term loan. A 6-12-month loan at prime plus 1.5-2.5% can fund bay expansions, tooling investments, or recall campaigns. It's a one-off solution when you need to upgrade your shop footprint or buy a specialized press. Now, how do you pick the right lender? Local banks and credit unions in Vancouver often have dedicated transportation or heavy equipment desks. For example, Vancity's Equipment Desk or Coastal Communities Fleet Group. They bundle floor plan, real estate, and parts lines for relationship pricing. Specialty service financiers move quickly and underwrite against your PSRNL, offering same-day draws and minimal covenants. When you negotiate, ask for interest-only draw periods. Get the first 30 to 60 days of each draw interest-only to align with typical payment cycles. Flexible borrowing-based tests. Match audit frequency to your invoicing monthly if you run high volumes to avoid sudden line reductions. Accordion rights. Lock in the ability to expand your facility mid-year as your parts business grows without full re-underwriting. Managing the line well means one more yes bangiwa one. Accurate, timely invoicing. Issue detailed service tickets immediately, parts codes, labor hours, serial numbers to prevent funding delays. 2. Customer notification. Let major accounts know payments should be directed to your financing facility's account to avoid misapplied remittances. 3. KPI monitoring. Track days, sales outstanding for service invoices, and line utilization weekly, aiming to keep DSO comfortably within your draw window. Here are 3 action steps. Audit your receivables. List your top 5 service customers by monthly billings, note their terms, and gather aging data. Solicit term sheets. Get proposals for a receivables revolver, an inventory line, and a short-term loan from 2 banks and 1 specialty lender. Compare advance rates, fees, covenants, and draw processes. Model your cash flow. Build a 60-day forecast of parts payables, payroll runs, and incoming payments to size your facility and schedule draws precisely. By layering a receivables-backed revolver, an inventory-secured line, and targeted term loans, and by negotiating flexible terms and managing draws strategically, you'll ensure your Vancouver parts and service operations never run out of cash or inventory, keeping BC fleets on the road and revenue flowing. Thanks for listening. I'm Haider Malik. See you next time on the Mehmi Financial Group podcast.